Hello, Sheila Rossi here. Today we are going to talk about the dreaded conversation of life insurance. Not many people like to talk about life insurance, but it's very important. Most of the time, people do need to have some type of life insurance. So I do just want to educate you all a little bit about some of the more common policies that we see, and also just give you a little bit of information about them. So the first thing I'd like to talk about is the 2-year contestability period. The 2-year contestability period is basically if somebody were to pass away in the first 2 years of having a policy, the insurance company has the right to investigate that claim. This does not necessarily mean that the carrier won't pay out on the policy. It just means that if someone recently took out a policy or within the first 2 years and they were to pass away, the insurance company can legally look into that claim just to make sure that that person was truthful and honest on their application. So I'm going to give you 2 examples. The first example is, let's say somebody took out a life insurance policy and they had a heart attack a month ago. And the health question says, have you had a heart attack in the last 12 months? And that person says, no. Let's say they get approved for the policy and then within the first 2 years they were to pass away and file a claim. Then the insurance company investigates that claim and they find out that in the medical records that person did have a heart attack just a month before they took the policy out. They do not legally have to pay that claim, as they shouldn't. Now, let's say person number 2 took out life insurance and they answered no to the heart attack question and they did not have a heart attack, but they did die in the first 2 years, then absolutely the insurance company is going to pay that claim as long as that person was approved for an immediate benefit. So many people get confused about that 2-year contestability period, thinking that if they take out life insurance, then they have to automatically wait 2 years. That is not true. However, those first 2 years, if somebody does pass away in the first 2 years, the company most likely will investigate and make sure everything was truthful. So this could hold up the policy from being paid out. After that 2-year and 1 day mark, there are no questions asked. The insurance company, once they get that claim and everything that they need, they're going to just pay out immediately. So now that being said, I'd like to talk about 3 different types of insurance policies. The first one is whole life, the second one is term, and the third one is universal life. Whole life is my absolute favorite type of insurance policy because it goes your whole life. So you never have to worry about turning a certain age and that policy ends. So if I take out a policy today at my age, that price will also be locked in for the rest of my life. So even in 20, 30 years, I'll still be paying the same price. And also I can count on that policy for the rest of my life. I don't have to worry about when I turn 50, 60, 70, 80, 90 years old that my insurance is going to end, because I have it my whole life. A few things about whole life that are nice. One is the cash value. As you grow cash value in the policy, you do have access to use that. However, if you do borrow against that policy and the cash value, there will be a loan put on your policy with an interest rate. And if you don't pay it back, whatever that balance is will come off of the death benefit. So I'd like to tell everybody that only use that for absolute worst case scenario. But it's good to have as emergencies. Also, you may have an option to roll that cash over to a paid up policy at some point and no longer have a premium. Some whole life policies do have dividend options where you can use that dividend money and never pay that money back, or you can add the dividends on top of your death benefit so your benefit will actually grow. So there are some wonderful things about whole life that come with the policies, or that you can add with certain companies. But my favorite thing is that it does go the rest of your life. The next policy I'd like to talk about is term insurance. Term insurance is basically temporary insurance. So if you take out a 10-year term insurance, at the end of the 10 years, the policy will expire. Same if it's 20 years, 30 years, whatever it is, the policy will eventually expire. And many policies, the rate does increase as you get older. So this is something to pay close attention to. We see a lot of letters go out in the mail to people about term insurance, and it will say, it may look confusing, like it will never end. So people think it's whole life, but it come to find out at age 80 or 90, it does end. And this is one of the reasons we like to review policies, just to make sure that there isn't anything like that if that's not what somebody wants. Now, term insurance is nice because you can get a really low rate in most situations, but that's because it's temporary. Now, about 2% or less of term insurances end up paying out, typically because the person outlives the term. So just make sure if you take out a term insurance, it's really what you want. A good scenario to have a term insurance is if you have a mortgage. You want to protect your family from having to pay that mortgage if you were to pass away, and let's say it's a 20 or 30-year mortgage. Or if you have small children, and in my situation, I have a daughter, so if I passed away, I have term insurance because that way my husband can take care of any bills that we have and needs and anything to take care of her while she's still young. So that's a good situation to have term insurance, because at the end of the 20-year term, she'll be old enough, she should be able to take care of herself. But if something happened to me before that ended, that wouldn't change the bill situation for my husband. So he'd still have all the same bills for the most part, utilities and home bills and groceries and all of that for her, but he'd only have one income. So that's just one way that term insurance is nice, because it can protect your family. And there's many other reasons for it, but that's just one example. They're really low rates, but again, they do end at a certain time. They can go up in price. If you do take out term insurance, I recommend finding one that the rate is locked in for the entire duration of the term. Lastly, I would like to talk about universal life policies. Now, these can get really confusing for people and tricky, so I'm not going to go too far into detail because there's different types of universal life policies. But the two main ones that I seem to run into are the guaranteed universal life, which is one of the better ones to have in my opinion, and the adjustable premium life, okay? That one is not so much my favorite, because whenever you see adjustable premium without any kind of guaranteed rider to the policy, the death benefit can change and the cash value can change and the premium can change. So for example, with some universal life policies, the older you get, the cost of insurance naturally goes up with the age. And as that happens, the premium's affected. Now, typically with those policies, they use the cash value in the policy to pay the difference of what you've been paying and what the cost has gone up to. So some people won't even notice that their premium has gone up because they haven't had to make any additional premiums. But what happens is once their cash value in the policy completely runs out, the carrier is going to say, hey, all the cash is gone, the cost of insurance is this amount, your premium is this amount now, you need to pay more money. So these are very careful. It's very important to look carefully at your policy just to make sure that you don't have any unwanted surprises later about it. With the guaranteed universal life, I love these policies because there's a guaranteed rider on them where the premium will not go up as long as you don't touch the cash value. Many of them don't grow cash value, but if there's any cash value showing, I recommend don't touching that, just leave that alone, and then you can keep your rate the same. With these policies, they go anywhere to age 90 up to 120. So it's kind of a mix between whole life and term. The price is right between what a term and whole life would cost. So it's a more affordable way to take out a larger death benefit and being able to stay within a decent budget for most people. So those are the three types of insurance policies that we tend to run into the most and have questions about. So I just want to get that information out there. I didn't go too much into detail because I could talk forever on this subject. So if you have any questions or anything, as always, leave a comment, call or text the number. I'll leave all this at the end of this video. Reach out to us on Facebook, Instagram, or on here. But All of this is important to review every 12 to 18 months. It's good to take a look at your policy and find out what it is, what you have. Make sure that it still fits your needs, as all of our needs change faster than ever right now. So maybe you need more coverage, or maybe you don't need as much as you took out originally. So it's good to just kind of do a little review on that. And we're happy to do that, educate you on what you have, and also shop all the different companies and find the right policy for you. And see what that is. So please do contact us if we can help you in any way. Share this video with a friend or family member who maybe needs a little clarification on life insurance. And be sure to like this video and subscribe to this channel, Southeast Brokers, to stay updated.